Well, I've been harping on ultra low interest rates for a little while now. First, I've argued that the Fed has in the past kept interest rates too low for too long, and they're setting themselves up on a path to do the exact same thing again. I've also argued that ultra low interest rates have allowed zombie companies or companies that really shouldn't survive to survive. This has a detrimental effect on society that's only going to grow. I talk about both of those things. You can look at those in the links here below. Today, I'm going to argue that ultra low interest rates are also leading to rising market concentration and falling productivity growth. Now, if we think about market leaders versus market followers, and in a low interest rate environment, what we're seeing is that the investment response from the leaders is stronger and faster, and this is leading to productivity growth for them. But the opposite is true for followers. Their investment response isn't there, and their productivity growth is declining, leading to a divergence between the two types of companies. In terms of market concentration, again, there is substantial evidence that low interest rates are leading towards more market concentration. One of the side effects of market concentration is a substantial decline in productivity growth. Again, this may not be true for the leaders, but it is true for the overall economy. When we have market concentration, we're seeing markups. That is, these industry leaders that have a bigger market share, some monopolistic type power, they're able to raise prices and increase the margins and their profit. And this also is leading to a decline in competition. So for the customer, it's not necessarily a good thing. Now, we're saying here that productivity growth is both affected in terms of the differentials between different types of companies, but overall. So let's take a look at that chart that was on the first page again. Here we can see that, in fact, as I'm arguing, that productivity growth has really stalled in this era of ultra low rate interest rates that started at the beginning of the financial crisis. You can see that here in this chart for the UK. Now, these same things we're talking about also have ramifications in terms of antitrust. At some point, we might decide that the negative consequences of market concentration and lack of competition would require some kind of antitrust rules, laws, et cetera, that or breakups of the types of companies that we think of in terms of having these monopolistic powers. Ultimately, again, the negative side effects of ultra low interest rates aren't good. It's allowing the weakest companies to survive when they probably shouldn't, and these are magnifying to a point where it's going to be very detrimental to society, to the economy, and also the ultra low interest rates seem to be providing the maximum benefits to the fittest companies, the companies that really don't need the help. Thanks so much for listening.